let's get started. What is Mercurius? So first of all, we are a startup. We are a technology startup, and what we do is basically crafting technology, AI technology, machine learning algorithms, more precisely. And what we want to do is to build technology infrastructure for managing risk in sports trading, and turn sports into a new asset class. And as you can imagine, as sports, it can be a very interesting asset class, because compared to the other ones, and or even compared to the alternative world, it's very liquid, as you have positions that are basically settled every week, or in this period also faster. And then it's very, very uncorrelated. You will see it with Lorenzo. He will start with an introduction on 2020 and what happened, and how actually Mercurius Tradr proved to be very uncorrelated from the rest of the economy. So, and at the end, last but not least, is that you can have pretty interesting results and returns. So I was mentioning that we built technology, but what is this technology? So let me say that first of all, it's our proprietary technology. We are a bunch of nerds, basically, and so everything is built in-house. And our artificial intelligence enable us to find edges in the sports betting market through basically running fundamental analysis. And how we do this, our technology structure in this way. We have these three layers. The core AI, how we call it, basically takes a lot of data from Wisecout. I suppose that there should be also some of our friends from Wisecout joining the webinar, if I saw correctly. And so hi everybody. And we basically gather all this data that is about the in-game, so what is actually happening during the match, and we use that to create probabilities. And then it goes through another layer where we turn these probabilities into trading signals and try to execute them automatically at the best odds possible, or the best odds that we managed to find. And as you can see, then this execution can be run on different platforms. The product that we're talking about tonight is Tradr, and is on Betfair Exchange, but we are actually working on different solutions for different segments that are also going on other brokers or platforms. So I was mentioning that we are a bunch of nerds. We are indeed. We are a small team, but great talents that we hired. And as you can see, we have PhDs, we have engineers, data scientists. We are this kind of people. And just to give you an idea, we are a startup, so we raise capital from venture capital and business angels to kick off the company. It took us quite a bit to create the foundation of this technology, and then in 2019 we created our first product. You'll find out all the information. Actually, sorry, our first automated product. You find all the information on the website. It's you simply have to connect your Betfair account, and everything will happen automatically, run by our artificial intelligence. We are also opening a funding round, because last year we started working with an asset manager. It got very exciting, and so we decided to kick off a B2B line, and we want to scale that new solution. So we're open to new partnership, to new investors. But I think so. I think it's enough chit chats as we can see. I hope that it didn't bore you too much. I'll invite now Lorenzo, and so he can take over. Just give me a second. So I'll invite him on stage. Let's see if he's ready. And then he will take over. He will basically walk you through our last 2 years. Hi, Lorenzo. Welcome.
Can you hear me and see me?
Good. Yeah, I can hear you fine. I suppose that everybody else can as well, as they can hear myself. Maybe it's worth that you share your screen so you are. It's easier for you to go through the slides.
Sure.
So meanwhile, he's preparing exactly. I think it's wrong. Sorry. Wrong one. So Lorenzo is my co-founder, and good. I think it's my co-founder. I was mentioning at the beginning. He is our head of trading, so he's the mastermind behind everything that our artificial intelligence does. So again, thank you, Lorenzo. So you can take over and go on.
Thanks, Mario, for the kind introduction. I'm just going to spend a few words about me before digging into the numbers. I am a physics engineer and applied mathematician, let's say, by degree. I have a strong focus on Bayesian analysis, machine learning techniques, as well as convex optimization techniques. And I've always been passionate about sports, mathematical modeling, complex systems and phenomena, innovation in general, and of course, the financial universe. So actually, just straight out of university, I was being involved in an IoT project for an Italian telco company, but the obsession to bridge the gap between quantitative finance and sports betting led me to start Mercurius together with my partners Mario and Fabrizio. So since 2019, my job is to oversee our research department and make sure we are correctly applying the most cutting-edge modern data science techniques and, let's say, the concepts of quantitative finance to the universe of algorithm sport trading. So today, I will review the first 2 years of trading with Mercurius, and I will be more than happy to walk you through the numbers, address your questions later on during the Q&A session, and hopefully solve your doubts about what we do. So let's start from, let's say, the ground truth. 2020 has many definitions. I don't want to spend too many words on it, but let's call it a tough year. So since the virus outbreak, we all witnessed something really unprecedented on any sector and in any aspect of our life. Strongly restrictive measures, lockdowns, and in general, lots and lots of sacrifice that we had to make to adapt our life to this emergency. And I do think this picture kind of gives the idea of what we went through and we are still going through. But then I want to start drifting from, let's say, a global macro level towards, let's say, the more relevant universe of investments and how 2020 was, let's say, a particular year to use, to say the least, and it actually confirmed to be one of the weirdest year ever. So as the pandemic spread rapidly across the globe, what we saw was first an unprecedented shock that happened across all global markets and across all asset classes. And we are speaking not only of one of the worst drawdown ever, we are speaking about, I think, 20, 30, 40% across all major asset classes, but it was also one of the fastest ever. So in some sense, it was really brutal. But then we witnessed it to something which might be even more surprising, which is the fact that across the year, actually most of those asset classes actually recovered over time. And this is due mainly by, let's say, the combined action of central banks and governments who poured a lot of liquidity in the markets and implemented, let's say, policies to ease spending and investing in general. So actually what we saw was that this growth was such that at the end of the year, most of asset classes actually recovered the losses and actually netted a positive result, apart from particular asset classes, for example, crude oil or real estate, which of course have still a long way to go. So the actually outstanding fact here is that probably there hasn't been a more severe clash between what traditionally are called Main Street, so the real economy people, and Wall Street, so the financial sector and the trading floors of financial institutions. So given this massive clash, we at Mercurius are definitely under the impression that a correction is due to come sooner or later, as the monetary supply is really huge. The low interest rates, of course, tend to keep up prices, but either we are living in some sort of bubble, and I'm thinking about, I don't know, the technological sector, or basically we had a sort of free lunch whose bill will come in the future. But apart from these contrarian views, let's talk about a little bit what happened to sports trading and sports in general. Of course, we all remember that for several weeks, all games were stopped. People even speculated the entire sport industry was doomed and condemned to shut down indefinitely. But likely, and thanks to the hard work of sport organizations and governments, they were able, at least for the elite competitions, to ensure their continuity. And actually what we saw is that it kept working something like business as usual. So now we have games playing. Of course, we have some weirdness every now and then, and we will talk it about later, but still we can safely say that in general, the sports, the entertainment industry that we take as an underlying phenomenon was extremely anti-fragile and robust, even to an epidemic outbreak. Now let's start finally digging into numbers and the trading review of those 2 years. Let's just make a due premise, which is the fact that it's not the first time that we show our results. Actually, we constantly do so. We maintain a public track record on our website. You can find the link on the slide. And basically, this is the most comfortable way of showing all the operations that we make. You will find the complete list of operations, and also to find a way to standardize what the returns would have been over time for an hypothetical client who would join Mercurius at any given point in time. So we needed to make some assumptions. So on that track record you find online, there is not the representation of different users' allocations on different strategies. And of course, there is no compounding effect, as we are assuming on that page, so-called unit staking. So basically, we assume to place 1 unit. It could be $1, $100, whatever. It just serves as a unit of measure. And of course, in this way, there is no compounding effect, which is something which in reality has its impact, and we will see it later. But as a matter of fact, we are really committed to transparency, and you can find our publicly available track record anytime through our website. Now let's talk about the hot stuff, and those are the key figures for the so-called average client of Mercurius from 2019 to 2020. So if you want to make the long story short and look only at the total return generated across the 2 years, well, we see that we are now netting a plus 24% across 24 months. And I do think it's a pretty solid result. It shows also that despite being a really young asset class, And of course, it will need more years to consolidate numbers. But those figures already look really positive, and that prove that the hard work that we are making is providing value and paying off. In order also to guide you a little bit more about how to read the table, let me just quickly define what some variable means. Maybe some of them are pretty self-explanatory, for example, the total return or even the number of bets. I wanted to focus on 3 of them, which are the yield, the average odds, and also the so-called ROMAD, which stands for return over maximum drawdown. So the average odds are, of course, the average odds that we have taken across that year, and it represents the average payout that a single operation has in our strategy. Of course, who comes from the betting world is super straightforward. Just bear with me and have some patience. On the other one, we have the yield, which is defined as the absolute profit divided by the total betting volume that you generated over a given period of time. So this is actually an intensive measure, which gives you an idea of how profitable is every single operation on average. So just like if you had an hypothetical portfolio made of all equal bets, then in our case, they will generate a 1.96% for each operation. And then, last but not the least, there is this metric we call ROMAD, which is defined as we were saying before, the return over maximum drawdown, which we believe is the best measure of risk-adjusted return, which we can borrow from finance, because it is stated as the ratio between the return, so the first line that you see, the total return, divided by the maximum drawdown, which is the maximum loss that you could have experienced in that period of time. Now, I've talked about the overall performances, but it is striking the fact that we had really different returns across the 2 years. But this does not surprise us that much, because we know that we are trading really volatile events and that the intrinsic volatility has its impact. So on the first year, we had a really awesome kickstart. I don't think there is much to comment. The performance were really robust. Whereas in the second year, in 2020, and I will spend a few words also later, and we'll see also the time evolution, we netted with a loss of 88%. And of course, it is not a good figure. We are super proud, but we are grown men. We don't live in a dream, and we live in the real world. So we operate with a profile which, of course, is high risk, high reward. So we need to embrace volatility if we want to be regularly exposed to such attractive returns and upside potential. Of course, the other side of the medal is that we can suffer losses for limited periods of time, but all it takes is trusting the process and seeing things with the right perspective, as I will show you in the next slide. So this was the full evolution of our, let's say, portfolio wallets. And one thing you will immediately notice is that we are not plotting only a single line, because again, we are not a mutual fund, we are not a collective scheme, we are a technology provider, and we let's say control a distributed set of wallets. So we don't have a single point of execution, which means that our users might hit different odds for the same match. So here it's a way to show how this has an impact, but also how we, of course, take as, let's say, a reference, the average odds, which is weighted by the money that were allocated at a given price. Now, the questions here are a couple. The first one is, who gets to obtain the better odds? Where here the policy is simple. The bigger your wallet, the better the price we will try to execute your order with, and therefore the higher the chances your performance will be in the top tier. On the contrary, the lower your wallet, the higher the probability you will be in the lower tiers. But again, what we are really focusing on our execution layer is to reduce this spread as much as possible, but it is something which is going to stay there, at least for a considerable amount of spread for given prices. And another comment I wanted to make is that, as Mario was saying, we didn't have the massive drawdowns all other assets had during, let's say, between Q1 and Q2 or in springtime. Actually, our return equity line kept smoothly going up. And this actually shows that this is a product which is really recession proof. Then the other side of the coin is that when markets kind of reacted, we had our bad months in October, which actually brought down the annual performance in the negative land. But still, to look at the half empty, half full glass, we can see that actually our strategy basically don't care to what happens in the outside world, as long as players are allowed to play on the pitch, of course. This is again a table which reports all the KPIs I showed you at the beginning. And there is also the breakdown by, let's say, tier of portfolio, either it be minimum, maximum, and the average one, which is, of course, the main one, the reference one. The only thing I wanted to note here and stress it even further is that total return differences among, let's say, columns are basically only due to the different average odds. So the driver in that differences is, of course, the average odds that were taken in each column. And another thing which I think is worth a comment is that, on the contrary, the let's say maximum drawdown measures are really way less impacted by the average odds, and this comes with no surprise, as of course the drawdowns happen when we have a bad streak of losses, and when you have a bad streak of losses, it doesn't matter much what prices you got, you still lose the amount you placed on that operation. This is a final zoom on the last year, on 2020. So you can see the quarter by quarter breakdown, and a little bit of a zoom on the minimum, the average, and the maximum profile. The thing I want to notice is that it was mainly, again, the fourth quarter to characterize the whole year performance, and that actually the maximum profile even broken even at the end of the year. So this is a way to see how also the amount of money you allocate with Mercurius may impact your returns. For the, let's say, for the ones that were paying more attention, also in the previous chapters and the previous webinars, we actually have multiple strategies now running at the same time. And this is a news which was introduced actually in the second half of the year. So actually, what we had so far was the conservative strategy, which was the only one running up to July 2020, and then we had two strategies in parallel running from July to up to these days. And here I wanted to give you the breakdown of the performances by strategy in order to let you understand how they behaved this negative year. And as you can see, the conservative one netted a -7 point something, whereas the aggressive accumulated a much bigger loss, around 18%. The immediate question that was triggered here is, well, if that is the breakdown of the different profiles, how is it possible that we achieved a net -0.8 something? Well, the answer is that we do not have the same amount of funds allocated on each strategy. Actually, what we have is that the vast majority of funds are allocated through the conservative one. The ratio is between 2/3 and 3/4, so like like the big majority of funds are allocated there, and that's why let's say the overall aggregated performance is really skewed towards the conservative one. But here there is a number that maybe is striking you the most and making you puzzling about, but is it good or what are they doing? So here I want next to address the fact that we achieved a minus 18% in 6 months of the aggressive strategy, but I want to provide you a framework to avoid emotional judgments and put things in perspective. So how do we assess those numbers? How do you say if these are good or bad? Well, what we can do is, again, find a quantitative approach, data-driven. And what we made was took all our backtest analysis and for the aggressive strategy, simulate all the possible returns, so all the distribution of possible returns that a portfolio that lasted only 6 months could have generated. And here you can find that, let's say, distribution of possible outcomes. They range from minus 26 up to plus 72. And what we need to see is that if the value that we observe is outside of this range, then we might have a problem. Then an anomaly would have been detected, which in turn would have triggered further investigation. Then what we discovered is that it's, this minus 18.2 is possible. We know that actually there is even a 10% probability that the return could be even lower in this really small period of time of 6 months. And another evidence which came up out of this analysis is that actually the chance of being in negative land again after only 6 months in general is about 20%. So this gives us some hint to the fact that 6 months is generally a really small period of time to judge. In fact, if we replicate the very same analysis on the conservative strategies on the 12 months period, so since we had 2019 and 2020, and we make the same exercise, which is simulating all the monthly returns for 12 months portfolios and order them and see where the realized ones lie, well, we find again, no surprise, that the first year was actually in the realm of possibility. Actually, it wasn't even one of the best outcomes we could hope for, because there is even a 20% chance that in a year we profit even more than that. And in the second year, we had a minus 7.2, which again is in the realm of possibility. And again, we have a not so small, actually almost 15% of probability of losing more than that on a 12 months horizon. In order to conclude this analysis and to come to a conclusion, this is the let's say the ultimate analysis that we perform constantly, which is of course giving enough time to our strategies to reach, let's say, statistical significance. And therefore here you can see that when we make the same exercise, which is getting the conservative strategies backtested returns, order them by return, and considering, of course, only those that lasted at least 24 months, then what we see is that first, the distributional result is really skewed towards, let's say, the right hand side. And we see that the result that we achieved, so the almost 25%, is perfectly in line with expectation. It was actually one of the most frequent we should expect. But I want to conclude this section before giving the words to Carlo, is that actually after 24 months, our analysis suggests that there is an almost negligible chance of netting a loss. So this is the real way we should read our numbers in perspective. And the only way to do this is to compare the observed real result with the simulated backtest that we make to set expectation and to also to set the targets of our executions, and keep monitoring if those values are out of the allowed range. And so far, we are pretty proud to keep seeing that the returns keep behaving as expected. Sorry for taking a long run on numbers. I'm now gonna leave the words to Carlo.
I think, okay, sorry. Can you hear me now? Yeah. Thank you, Lorenzo. Thank you very much for your contribution. And yes, I'll invite Carlo right now so he can continue with the next session. I think it was pretty good. I saw already. I'm happy that our transparency is appreciated. This time I'm keeping the chat live. So I'm really happy that you appreciate the effort that we put in being as much transparent as we can, and because we believe it's fundamental especially for this industry. There is not very much transparency, honestly. So Lorenzo, I'll close the video for you and invite Carlo on stage, so it's easier for him to present. Let's see if Carlo is ready. And just I want to do just a couple of comments on what Lorenzo said. Hi, Carlo, welcome. And before continuing, so one about the questions. I saw that many of you already started posting questions. Very good. Thank you very much. So there is a button below, ask a question. If you use that, you can also vote them, and at the end we are going through all the questions based on votes, but also what we believe is most interesting. And yeah, and then another thing is just let me clarify that in many regards, of course, Lorenzo was talking on a global level of what happened in the economy. We're talking about the fact that we take inspiration in finance, and we hope that one day sports is going to become an asset class. But of course, we, as also Lorenzo said, we are not a fund or anything like that. We are still talking about sports trading or gambling, as you want to put it. It's betting. The application that I was mentioning before, I'm gonna show you a bit more later on. Maybe it's worth also in the Q&A session. It's an application for Betfair, so it's still about betting and gambling. So we have always to remember that it's still a matter of chances and a matter of risking money and taking the risk that you can afford. Of course, nothing more, nothing less. Carlo, you can share your screen with presentation if you want. So we start with the second part. And
can you hear me?
Yeah. Yes, can hear you. Shaft, thank you for question. If you post it in the ask question, then we will go through and answer it at the end. As you could see, some of the questions we already answered. Carlo was so great to start answering you by message, but let's keep it for later on. So sorry for taking so long for my comments. Carlo, the stage is yours. I'll close my camera and stay here. See you later. Bye.
Okay. Bye, Mario. Okay, guys. So I'm going to talk about uncertainty mainly because, as we know, football has changed in 2020. So how football changed? First of all, there have been a pause in the matches for like 2 months. So a lot of the players had to train at home without the coaches, without the team, and some of them came to the field out of shape. And as well, they had to recover a tighter schedule of matches because during these 2 months, they have been paused. And this caused a permanent changes as well in leagues as China, where we have seen that the league structure completely changed by being divided, let's say, into sub-leagues. Another big changes which happened in sport, in football, obviously, is that there are 2 more substitutions. So the value of the bench is much more important, apparently now, and also the coaches can implement a different type of strategies for the team. And this change, we don't know yet if it's temporary or is it here to stay. Another element are the absentees, because obviously with the COVID spreading quite randomly, you risk of having last-minute lineup changes and matches postponed, which if you have a lot of matches postponed and you get your banker locked for some days, isn't the best thing ever. And as well, these new schedules force a really high-intensity rhythm for the players as well. Last but not least, and which is maybe the most talk about change in football, are empty stadiums, which have various layer of degree of affecting the beautiful game. First of all, higher financial risks for the clubs. Why? Because now, since the stadium are empty, when there is the mid-season market, probably the team couldn't afford the players they would have bought, so the ratings could change in that period of time. As well, the home advantage changed, is still there, but changed, so this must be accounted for. And last, it has been measured that there were players which had problem in performing in front of a crowd, which now are performing better, given these circumstances. So, sports trading changed in 2020, moving through trading on uncertainty, so betting against certainty and correctly evaluating the missing information. So the question we must answer now in this 2021, because obviously all this stuff that happened in 2020 is still here, is if we can read the uncertainty in the market and profit from it. So how is represented uncertainty in betting odds? So before moving to betting odds, we take the easiest possible example, which is the coin tossing. Okay, imagine that you don't have any knowledge about coin tossing. You just know that it can land on a head or a tail, and you don't have any historical record that could help you to use the frequentist approach to probability and statistics in order to compile the probability of the coin landing on a head or tail. So you don't know nothing. So max uncertainty, you have the only thing you can say is that you give equally distributed probabilities to the coin. So 50% chances of it landing on a head and 50% chances for it landing on a tail. Let's do the opposite case where certainty is maximized. Imagine you have a rigged coin where you know that it has two head on both sides. So you know that it's certain that it will land on it. So the distribution is not even as before, but it's completely skewed towards the heads. So you have 100% chances of the coin landing on a head and 0% chances of it landing on tail. As you probably know, betting odds are just probabilities in another form. So let's see 2 practical examples of where uncertainty is maximized in betting odds and certainty is maximized. So example on the left, we see this match, Sebeta City Bahir, which is a match between 2 Ethiopian teams. As shown in the odds, there is pretty no information about this match. So we can see that the odds on the home team to win and the away team to win are equal. So even the home advantage isn't computed. Just we see a difference in odds of the draw because draw is less likely probable. So this is the only information accounted for. On the right, we have probably, which is like the most certain match in the history of football, which is Germany against San Marino. You can see that odds are completely skewed in the direction of Germany, are that much skewed that even Betfair isn't offering a bet on Germany and either marathon or cool bet. So they're completely asymmetric there. So when we want to profit from uncertainty, we are trying to assess if the certainty about a certain event of the market is maybe too much. So we are trying to evaluate how good is the information the market has about that event and how much certain they are about it. And this is up completely to the trader skill, to the, let's say, the professional gambler skill. So in order to approach this, we are going to talk about fundamental analysis, which is compiling odds from the actual match event, compiling the fair odds, and not deriving it from price movements in the market, so from price action. So we are trying to compute odds from the actual event. So there are two approaches to fundamental analysis. There is the qualitative approach and the quantitative approach. Obviously, at Mercurius, we are using the quantitative one. So let's talk about the qualitative approach. So by qualitative approach is the purpose of qualitative approach is using non-quantitative information in order to spot edges in the odds. A good example was proposed by Andrew Mack, who is a famous professional gambler from Canada. And he noticed an example that during this preseason of NBA, teams were kind of afraid of, the players were kind of afraid of getting too much close to another player, obviously for fear of getting COVID. So, and this wasn't correctly revealed by common data feeds like the ones from Opta, in example. So qualitative trading is like spotting those type of edges. So what you're trying to achieve is checking odds that are not discounting some sort of information. And usually you find the expected value when the market doesn't take in consideration this type of information, like, for example, an injury that you only know about because you was checking the Instagram account of the player and the market didn't. While the quantitative side of fundamental analysis is using a historical record of data to compute fair odds. So you are comparing, so in the end you compare your fair odds with the ones offered by the market. And usually you find a positive expected value where the market overreacts to information. So now we will delve deeper, first into the qualitative approach and then into the quantitative one. So let's talk about the qualitative side. Obviously, it has its pros and its downside as well. Its main advantage is that it's based on human intuition, so you are more reactive to new things happening and you can be faster to adapt to changes. The downsides are that it's not rigorous, so it's difficult to backtest if you're correctly working or not, and as well is subject to human bias. So you risk to be entangled into narratives, as we will see later in the slides, and also is difficult to automate and scale in the long term. So here are two examples of trades done using a qualitative analysis by me in the past, betting against certainty on a given football match. So this is the first example. It was the match between Milan and Dudelange at the end of Europa League season, so in 2018. So as you can see, the final result was 5-2 for Milan, and the odds, these are the closing odds, were heavily skewed in favor of a Milan win. And my perception about that match was that the market was over certain about this type of match. Why? Because Dudelange is a team from the Luxembourg division. So the fan base of Milan is bigger than the whole population of Luxembourg. So you have all these volumes coming from that fan base, skewing the odds in Milan direction. There was a narrative attached to that game, which was Milan had to win, because if it lost that match, it couldn't go further in Europa League, while Dudelange was just playing for the glory. So, and while the market priced it as an incentive for Milan to win, I was pricing it as a psychological pressure, mainly because Gattuso were risking of being fired if he lost that match. Another important element is that it's very, very difficult to price Europa League matches, because you have teams coming from different countries, and it's really difficult to assess the relative ratings and the relative strength between the two. So, and Dudelange is coming from a niche league, which is the Luxembourg one, for which there is not really a good historical record. There are not really granular data feed. So for the quantitative side for the quantitative traders, for the odds compiler, is kind of difficult to correctly price it. So what I did on match day on Bet365, Dudelange was priced at 150, while on Pinnacle, for the ones of you who don't know, Pinnacle is usually the sharpest bookmaker around, was already trading at around odds of 50-40. So waiting all of this, I placed my bet on Dudelange, and in end, as you can see, the market closed at 27, so it was possible to cash in for a good profit. This means that the uncertainty about this match was higher than initially expected by the market. Indeed, Dudelange played fairly well, and after half time, it was leading, and it was offered by at odds of around 2. So if you managed to keep your position open in play, you could have even profited for more. So another example, which is a more easy one and a more recent one, was Aston Villa Liverpool in Carabao Cup in 2019. So what happened? This is interesting because 2 weeks prior of match day, it was announced that Liverpool would field an under-23 team. So odds of a Liverpool win went from 2 up to 13-12 range. So the market was pricing as certain that Liverpool would have fielded that underage team. But as you can anticipate, it's impossible to be certain about something 2 weeks in advance. Not only there was this degree of uncertainty, I thought as well that pricing an under-23 team against a Premier League team like Aston Villa isn't that easy. Also because 5 players of the team were at like their first appearance. They were highly motivated to show the scouts that they were good players. So which was the trade? The trade was straightforward. In 2 weeks in advance, I placed my bet at odds of 12-13. Luckily, I took a screenshot of it, and on closing to match days, odds dropped, and I closed my position. But to confirm that indeed the market was underestimating the under-23 side, also it lost 5-0. In the first minutes of the matches, the kids were playing above the expectation, and indeed odds dropped further to the 4.5 range. So, which are the insights that we have to acknowledge when we want to approach betting on uncertainty using a qualitative approach? Obviously, we need to find matches where the distribution of odds is heavily asymmetric. This means that the perceived certainty about the final outcome by the market is high. It helps if there are low or no data, low quality data, stuff that is difficult to price, like friendlies, cup matches, as we have seen, for example, the Carabao Cup, team coming from different nationalities, etc. you should bet against the opening odds and not the closing one, because usually closing odds discount this type of uncertainty and information. In order to get an edge, you should check each possible piece of information available, Instagram accounts, forums of the fan base, to check if there is a tendency, some stuff going on. Obviously, the trade is conducted by betting on the under, because you expect odds shaping from an heavy asymmetric distribution to a more symmetric one. And in order to evaluate if it was correct in your trade, you need to check on if the odds dropped. So if the odds closed lower than the point you entered in the market, more than the actual outcome of the events, since these are still highly unlikely outcome. Now we move to the quantitative approach, which is also what we are doing at Mercurius. We are doing quantitative value betting. So the big advantage of the quantitative approach is that it's scalable. It's scalable by automating data feed. It's scalable by analysis of the data. Every aspect of it is much more scalable than the human intuition. Another important aspect is that you remove personal biases that you can, so you don't risk to get entangled into narratives, as we will see later. Is evidence-based, so you can run a statistical significant test and use a more scientific approach, and usually it's much more consistent in the long term. Obviously, it has its downsides as well. So the main problem is that it's kind of slow in reacting to new information, because you need to infer the future by looking at historical data. So it's always backward looking, and it's kind of slower to adapt to abrupt changes, in this case, in football. Also, as data scientist says, garbage in, garbage out. So you have to always be precise on the data quality and having access to really good and granular data. So to better explain it, let's talk about two trades, two value bets we did at Mercurius. This one is probably the best example possible, is Palermo Empoli from 2017, when still Tradr was a dream. We were running our old models. It was like XG4, I think. So this is a really old trade. And why this is exactly the perfect example. So it was the last day of A Serie in Italy, Serie A. And there was this huge narrative attached to this game, which was pushed by media, newspaper. Everyone was talking about it on social media. People were claiming about the scandal. So I explained to you, Palermo was already relegated, so it wasn't playing for nothing. Not only it had an incentive to lose the match, because given the twisted regulations we have in Italy, if it had lost the match, it would have gathered a lot of money, really a lot of money, and it was in a troublesome financial situation. While Empoli had to win in order to remain in the fourth division. Not only, above all of that, Palermo's goalkeeper was an Empoli fan. So you had everyone in Italy claiming about the scandal, how this match would have resulted in an easy Empoli win. Indeed, as we can see by the market odds were skewed in favor of Empoli. And we know that because with a simple Dixon and Coles model, which is one of the most simplistic model to compute odds for a football match, a good fair odds would have been for Palermo around 2.9 was a good fair odds. Yet the market was trading it at around 6-7. So what this means? This means that if this narrative won't come out and Palermo will play as usual, you will have a massive expected value. Indeed, our old advisor placed a bet on it, and indeed Palermo played as usual and won the match. Another example, which is a recent one from 2020, Levante Getafe, end of the season, La Liga. Teams are returning to the leagues after the 2 months pause, so the market not yet as clear how to price home advantage. In this case, there was a narrative. Getafe had to win to qualify for Europa League, while Levante was playing for nothing in particular. So not only there was the narrative favoring Getafe, also the market was over-discounting the home advantage, and we were kind of faster in adapting to it. So our model at the time was Phoenix XG, had Levante around 30% to win, while the market was offering it from 6 to 7 range. So if it was true that the market was over-discounting the home advantage, and as well they were over-discounting the Levante morale, you would have gathered a positive expected value. Indeed, the match turned tighter than expected, and with a goal at the very last minute, Levante won it. So, which are the insights from quantitative trading against certainty, so betting on uncertainty? Obviously, for the qualitative side, you have to find matches where there are heavy asymmetrical odds. You need to have high quality data. So this works better on high liquidity leagues, mainstream leagues like Premier League, La Liga, Italian Serie A. On the contrary, you need, and also because this data feed are provided like by these massive data providers like Opta, Wisecout, StatsBomb, and you have to bet closer to the closing odds, not on the opening, because is when all the trend followers, all this effect done by the narrative could create more biased odds. So you are trying to profit from an overreaction of the market to the data. So as we have seen in matches where there is a huge narrative pushed, tends to work better. And in order to evaluate if you did correct, you have to check that closing odds won't drift too much against you. So, for example, if you had a bet at odds of around 3 and it drift against you at 3.20, it's still good. And you can really evaluate this really ex post if you have a positive yield. So by checking if in the long run you had positive returns. So, as we have seen, the 2021 trading metagame will be characterized by a high degree of uncertainty. Before COVID, quantitative traders, odds compilers, quantitative market makers usually had the advantage, but 2020 and 2021 can create this good opportunity window for the good quality traders to find, or gamblers to find good edges. Resuming, quantitative approach win when there is an overreaction by the market. Qualitative win when the market is not discount yet some type of information. So what we get from it is that both types can profit from correctly pricing uncertainty. So it's not that the qualitative or quantitative approach is better, simply you have to better in pricing the degree of uncertainty that there is on a given match. Now I'll get Lorenzo to speak on how to be a better trader, a better quantitative trader in this field, since he is kind of the expert more than me. Hope you enjoyed it. You can go, Lorenzo.
Thanks, Carlo, for the assist to speak soccer jargon. So as you were saying, of course, we are quants. Our philosophy is built in systematic quantitative trading. So what we actually have to do is to be smart. So it all boils down to this question: how can we be smarter quants in 2021, having observed, let's say, that amount of weirdness during 2020? So of course, we are going to focus, as Carlo was saying, that possibly this year it will be subject to qualitative traders or people in general that are able to capture relevant information faster than our models can do. So even if, again, and I will say that a little bit later, it is not that of extreme phenomenon, but still we know from theory that quantitative algorithms need many observations to start capturing effects. So what we will do is we'll try to improve the reactiveness of these of our currently in production models by injecting, for example, some parameters that will help correctly assess the fact that with high probability a full cluster of players rather than the single one is going to be missing for an extended period of time, which is really something different with respect to the normal, let's say, runaway of an injury or a disqualification. So here we will also try to model the consequent changes in, let's say, player load management as a consequence of a cluster of players missing due to COVID, and therefore how we, let's say, compute the fatigue analytics and how in general the tighter schedule will impact player performance in the long run. And then on the other side, since we do think that the biggest risks lie under the category of the so-called unknown unknowns, right? So on one side, we know that our models are blind or sort of blind to some given information. For example, a cluster of players which is going to miss for an extended period of time. On the other side, we will also know that there are risks we are still not aware of. And in this particular year, in 2021, we want to be more prudent also with regard to these aspects. So we will try to develop, let's say, the so-called smart heuristics that allows us to understand if a big price action that happens on betting markets close to the kickoff can be, to some certainty degree, attributed to a set of factors our models might overlook, and therefore take consequent action. So, for example, if we discover that a big price action is probably attributable to something our model is blind to, then we might decide to enter or not a given market, or possibly to decrease our exposition on that game. So these are the main two aspects we are going to work on, and this is I hope it helps also as an answer to Matthew, who was asking, but what are you doing to mitigate the probable factors that downgraded your performances? Well, on some level, we are actively, finding countermeasures to it by explicitly modeling cluster of players being absent, or trying to mitigate the impact of missing information by inferring it from the betting markets. But we do not have to fall on the opposite pitfall, which is to give too much weight and to recent data. So it would be a mistake to entirely attribute our negative performance to COVID, for example, because as we were showing at the beginning, actually, we only had a couple of bad months, actually September and October, whereas during July and June, which were after the, let's say, restart of competitions, our boat kept running really smoothly. So we as always, we need a rigorous, scientific and data-driven way of assessing what are the most impactful and useful measures. And to this regard, what I can ensure is that we will put a lot of efforts in understanding if something about 2020 is here to stay. But on the other side, we won't monopolize the analysis that we make, because history is made of chunks, and this is just a particular chapter we need to address, but it's not the whole story. So I hope I will I have also responded to Matthew's doubts about our actions, and probably I already started the Q&A session, despite Mario not giving the go.
Wrong button. Yeah, absolutely. So let me see if it makes sense to have us in this way. So yes, thank you very much, guys, and thank you, Lorenzo, for starting the Q&A session. Actually, so I was going through the question, and now let's start the Q&A session. Again, thank you. I think that the insights were pretty cool, and I saw a couple of exchanges of comments also on the chat, and I believe that both Matthew and Paul had a point. Maybe Lorenzo, you want briefly comment. I don't know if you could follow the conversation. It was a quick exchange on what Carlo was explaining, but if not, we can come back later on.
But I think that Paul made the point. I mean, Matthew, maybe you were a little bit extreme. I mean, by qualitative traders, we are not speaking about people that are not literate about math and numbers. On the contrary, the fact is that they do not have, let's say, an automated system to come up with fair odds. They actually have really strong and superior to the average analytical skills. So in their brains, their use is math. But it's not a reproducible algorithms that can generate fair odds. So in some sense, you both are right. Probably you were a little bit too extreme. But as Paul says, of course, traders factor in also quantitative information.
Yeah, like it's more than knowing exactly how much. Let's say Kobe Bryant by missing from Lakers affect the odds, is knowing that it will affect the odds in a positive manner. So for example, I know that if he is absent, odds on the other side could drift 10-20%, and already a 5-6% bring me in the value zone. I more need the information before rather than evaluating exactly how much it will drift. Obviously, it will drift that much that I have a positive expected value on the other side, but that is more spotted. Also, qualitative traders can spot it as well, of course, but it's typically more spotted by the good quantitative complier.
So I don't sorry. I don't want to start a conversation over the chat. Otherwise, it's really difficult to go on. But maybe for the one who missed it, maybe Lorenzo, you can say something quickly on the performance of last year. But then let's please not start having a conversation on the chat. Otherwise, it gets very difficult for us to moderate and go through all the questions.
Yeah, I do think we are going to distribute the slides as well, so you will find or some snippets of it. So you will find the figures I presented at the beginning. So just to recap a little bit, our first year performance on 2019, we performed 34% positive. Second year, so 2020, negative -8.2. So on aggregate is about 24%.
Profit. Okay, exactly. Good. So let's start with the true Q&A session. So I'm gonna read the questions and answer that you voted. So the most voted ones is also a question that appeared in the last webinar we did. So I think I can ask it to Lorenzo. The question is, why do you use standard stake proportion 1% instead of staking proportional to the probability of the event and the perceived value, like the Kelly staking plan?
Well, the answer is actually quite simple. On one side, it's true that we are able to estimate fair odds, but there is also uncertainty around that odds. So, for example, my models could say that Rome is expected to win with a 50% chance, but of course that number is 50% plus or minus something. So we have to take into consideration this sort of intrinsic uncertainty, and the Kelly criterion is super sensitive to these uncertainty. So if the prediction is 54 or 26 or 56, it will say to allocate a different amount on that event. So one reason why we don't do this is that we made our tests and we saw that it's really suboptimal because it increases variance a lot, and therefore it's not optimal from a risk management perspective. On the other side, it is also due to the fact that we, at least up to November, we only traded the 1x2 market. And actually what we found out was that actually the majority of our edge actually lied in the high long range odds. So even though it sounds intuitive to lower sizings on those odds, we would have left a lot of money on the table. So actually what we didn't do is not let's say adapting shorter odds. It's not let's say increasing the amounts on shorter odds, but to level out let's say the stakes that we place, because we think we have a similar level of edge per single operation, regardless of the probability. And that's a very few reason. Another one is that by using the Asian handicap, so as already Carlo was mentioning in the comments, we are shifting towards more and more bets that are placed around the range of 2. So with this regards, actually, the Kelly question is kind of not a question anymore, because around level odds, you basically should allocate exactly the amount that you perceive as expected value. But since this is a question, it's actually super sensible, because I mean Kelly is also famous in the quantitative finance. So maybe it triggers me the idea that we should make a proper post about it and analysis to doubts.
So, like Paul, I want just to add about the Kelly criterion, which I'm a huge fan of, by the way. It's that the Kelly criterion was originally built for blackjack, and in blackjack you are really sure about the true probabilities, since it's like the coin tossing example. When you have the same experiment, you can test the same experiment a lot. So this second layer of uncertainty about the odds, so the epistemologic side of probability, because we are talking about the probabilities of probabilities, is really under control. While in the sports betting side of things, where in the end each football match is completely unique, also we have historical record, but there is a big degree of uniqueness in each individual football match, you risk of underestimating that uncertainty. And as Taleb and Brown, if you want, Paul, I can send you some materials about it via email, pointed out also if you have a positive expected value. So imagine a scenario where you are always positive, but if you constantly overbet Kelly criterion, you will eventually get a ruin, no matter what. So since you have this degree of uncertainty, if you, let's say, stick to Kelly or half Kelly, and this degree of uncertainty is high, also you have positive expected value, you risk to be ruined, because you find yourself constantly overbetting Kelly. So by sticking to 1%, also 1% is max in our case. We sometimes take less than 1%. it's a good heuristic to try to maximize the probability of under betting a Kelly criterion in order to not find yourself in a ruin position. So this is kind of the concept.
Good. Thank you, guys. Very, very interesting answer, and probably we should definitely do an article on it because it keeps popping out. So I do another question, probably again for Lorenzo, but also Carlo may answer. Let me know. So actually, it's a very easy question. Have you simulated the returns that your system would have obtained 4 years before 2019?
Sure. That's we generally provide that information in our information documents. We run our back tests running from the 2015, 17, 16 season up to now. So we definitely do simulate the returns of our strategies, and it's actually part of the workflow which is needed to come up with profitable trading strategies. We need to do that. It's necessary. And maybe it wasn't clear enough, but those returns that are, let's say, simulated for the past years are the ones that I use to benchmark also the actual results that we have obtained in the real world. So in those slides where I put, the histograms with the lines, the histograms were fueled by the back testing. Those are the returns that we generated through the back testing, and then we compared to the actual ones in order to understand if the actual performance are to be investigated further because there is something not working. So we definitely do that. You can find all the information documents.
Yes, also in our information documents, there are links to all the bets placed in our backtest. The executed odds, we use Pinnacle closing odds for the backtest because we believe, and not only us, that they are like the sharpest odds around. And also in our backtest, you will see the probability we gave to each match. So you can evaluate it also with your own tools and see if maybe you like what you're seeing or is in line what also you think about.
Yeah, maybe Lorenzo, you can mention how far, how deep is our database of data, and how many years do we consider for the backtests?
Maybe I repeated it. The first season that we can simulate is the 2015, 2016, up to now. So it's a full 5 years of soccer games that we can simulate returns on, and that's it. I mean, we can run all the simulation that we want. And one particular aspect we put a lot of stress on is, of course, the maximum drawdown, which I was saying at the beginning is possibly the best risk metric which characterizes a given portfolio. And we estimate the maximum drawdown that characterizes a given strategies by sampling from the backtest. So this type of analysis is absolutely mandatory before doing anything else. So it's the first step. Every time that we have a candidate models, we backtest it.
Yeah, maybe just the last clarification regarding those histograms. The reason why we did that and we run that simulation was that we wanted to give you an overview, an idea of, or better, a correct comparison in time. So our information documents are showing a projection of over 5 years. And this strategy that Lorenzo presented, the aggressive one, was only 6 and something months. So we wanted to give you a right comparison in time, because at the end it's not really the time, the factor, but it's the number of operations, right, that you can do in a specific amount of time. So the reason was trying to get the right comparison so you could compare the same number of operations basically. So that's why we did that, and showing you how it progresses with increasing the number of operations. So sorry if I jumped in and got out from the moderator's role, but I think we can skip the second most voted question because we already answered it. But if not, maybe Matthew, let me know, because Matthew was asking what has changed the losses, and what are you going to do to what are you going to do in order to overcome? Sorry if I am stopping, but the software is asking me how. I don't want to add a session. Sorry, guys. I'll move on with the next question. So I guess you placed majority, or if not all, of your bets before the game starts.
Yeah.
Have you done an analysis on which in-play risk factor mostly caused your prediction to negatively diverge? If yes, do you edge some particular games to enhance overall returns? Thank you, Francesco. This is a very interesting question. Guys, who wants to take it?
I can go about it. So, Francesco, the problem about in-play is time. So, pre-match market and in-play market are two different markets. Pre-match market is a price discovery market. So no one knows which is the correct price of the forecast, let's say, and by an auction mechanism, which is just the people trading prices, you get to the closing odds, which is considered, let's say, an efficient odds, which predicts the correct price of the event. So it's a price discovering market. The in-play market is not a price discovery market, it's a price chasing market. So you are not pricing, you're not looking to find the correct price then. You're looking to correctly compute what has already happened. So it's not about forecasting, it's more about being forced in computing what had already happened and correctly discounting it in the current price. So it's not the field of our type of analysis. It's the field of, let's say, high frequency trading. So your algorithm to work there must be fast, and fast. They don't have to be right, they have to be fast. So it's completely another domain. And since we are computing like 200,000 data points per each individual match of the historical record, and we are using a Bayesian approach. So to all new piece of information we gather, we need to update all we know about the game. We take literally time to compute our feroz, since you're leveraging on billions of data points. So live, our approach is unfeasible because you should constantly update it, but you will be always constantly behind the market. Yet is why a lot of arbitrage, if you've ever done arbitrage betting, are in play. This is why a lot of manual traders or good gamblers find good edges in play as well. It's because it's exactly this kind of fast reaction market. Obviously, it's something we want to delve sooner than later. The first idea will be to bet halftime using the information from the first time of the match in order to adjust the odds, because you have a 15 minutes time to adjust your forecast. But yes, it's something we will do in the future, not now.
Just let me add just a couple of comments that we also, tried to investigate. Maybe the second part of the question can be interpreted in a different way. So why don't we hedge position live, for example, to lock in profits when maybe we back the underdog? Well, actually, we ran these analysis for a brief period of time, and what we discovered is that actually, again, we left money on the table. So as it is fairly intuitive, the underdog, either it's more frequently the one that concedes a goal before. So live, basically, there is no room for opportunity there, because if we back the underdog and it concedes a goal, then the odds will be even higher. And what we saw is that every time that we tried to hedge the risk of waiting up the final blown whistle, then we left money on the table, because eventually underdogs actually won the games, and the cost of not gaining that payout, because we hedged the position, was way more than the stability premium that we got by hedging position. So we tried that analysis, fairly interesting. Actually, we might look it next in the future, but as of now, it's not top in the priority list.
Yes, I wanted to just add that it makes sense hedging only if you have neutral expected value on the other side, because you are buying back volatility, or you have a positive expected value on the side. If you are hedging and you have negative expected value by hedging, by betting the opposite side, you are simply not only decreasing your profits, but since you are decreasing your profit, you are increasing your risk of ruin. Also, you are taming down volatility, because you are losing the profits that will cover your future drawdowns.
Correct.
Good, guys. It was a very in-depth question and answer. So now a couple of product-related questions. So is there a different solution for people that can use betfair.com? Is it possible an automation mode using another platform? Who wants to take it? Carlo, do you want to answer, or?
Yeah,
I can also.
We are actually developing infrastructure for betting brokers, so for Asian betting brokers, which let you access Asian lines like Pinnacle and this sort of market. So if you can access betting brokers, we are near to have the solution ready in that case.
Yeah, good. Then let's move to another question. It was not with many votes, but I think it's important to clarify it. I already answered by comments, but Enrique is asking, is it legal? Are you a betting syndicate?
Yeah, we are a syndicate, but a legal one.
So maybe I'll answer. No, actually, we are not a syndicate, so we operate. It could seem that we operate as a syndicate. We are not, and yes, it's legal, because our service is an application that is running on Betfair. We are a partner of Betfair. You can find our application on their app directory, and it basically providing you with automations and data analysis. So this is what the application does. And so yes, it's all perfectly legit. What Carlo was correctly saying is that I believe that the first time a company is trying to openly address this problem, creating a solution that is completely legal and clear, and this is something that we are very proud of, and we are very proud of being transparent and trying to allow people in a very simple way to enter in the sport betting market with a financial approach, and trying to do it with in a proper way, using math and getting inspired by the financial world.
Yes,
so
I think that we are a syndicate in the sense that we are performance based.
Exactly. No, I got it.
So since we are performance based, each syndicate is performance based. So in the end, our profits come from the performance of our product. It's not like a fixed type of subscription. So in a sense, we are a syndicate in that sense, not in the legal sense, but in the actual sense, yes.
Of course.
Made by us and our customers, which attach their accounts and their liquidity to our infrastructure.
So maybe another question regarding clients. I think Fed was John was asking what percentage of commission do you assume that Betfair takes as our tires, where they take 2, 5, or 10% on winning bets? Maybe Carlo, you can answer and you can explain how in general the partnership.
Yes, the partnership with Betfair works like that. So our customer, our user, have a 2% Betfair commission. Now each UK and Irish user can set it up by themselves. Before wasn't the case. So before we could provide instantly 2% commissions to Irish and UK customers. Now the deal is still there. So for everyone who has access to Betfair except Australians, and this is a problem, we can provide the 2% commission, and our bot works considering by default a 2% commission. So this is hugely important, because if you sign up and you don't have a 2% commission, we will see a discrepancy from the track record you see on your Tradr app and the actual profits on your Betfair account. So if you sign up, send me your username so that I can ask Betfair to set up you a 2% commission. This is mainly for the Netherlands customers, because they have a 6.5% commission on Betfair, and they can't set up the 2% manually, so they have to send me their email, and I have to contact Betfair to have them set up the discounted commission. And it's absolutely massively important having the 2%. It's really, really important.
So a couple of questions. This could be for you, Lorenzo. So how do you ensure you don't overbet in the theory by baking on then 1x2 and the NRO section?
I think I lost for a while.
Sorry, can you hear me?
Now, yes.
Okay. So Paul is asking, how do you ensure that you don't overbet in theory by baking on home draw away and the under over on the same selections?
That's a good question. We are, of course, limiting the amount that we place on a given match, on a given market, by 1%. So actually the risk could be of getting a 2% exposure maximum on the same outcome. And so we are not considering an excessive exposure, the 2% on a maximum, let's say on a maximum of 2% exposure. But I want to clarify a little bit. Actually, our Asian handicap models is focused on betting on the main lines, so the ones that are closer to the even odds level. And they are, let's say, slightly different models, so they don't project the same probabilities, and therefore we set different threshold levels or expected value to fire an order on the same market, on the same game, and on different markets. So there is a small chance that those two modules will place the same order. And when it is the case, which is something we, of course, analyzed in our backtests, it only happens on games that have a massive expected value, both on the 1x2 market and on the Asian handicap market, with a line which is around 2. So basically, what we are saying is that we are accepting a maximum exposure of 2% only on those games in which the value is that big and on not so high odds. So in order to contain again the risk and the risk of ruin. So they tend basically to operate at really different lines. So for example, we either bet I don't know, Manchester United to lose, and then we will bet on the Asian handicap market, maybe a huge handicap on the underdog. So of course there is a sort of overlap in outcomes, but the exact same exposure will happen only a really minority of events where actually we think have a huge expected value on a really, you know, nice odds. So it's intended, let's say.
Good. Asking if it's possible, where can I find some that technical information about the machine learning models that you're using, if they are
yes, there are some papers
available?
we always share. There are also in an automated email that you get if you download our information document. So this is a good reason for downloading it. But if you send me your email by sending me an email at carlo@mercurius.io, I'll gladly share to you some of the paper we used without issues.
Yeah, maybe are these papers about our actual models?
I mean, the literature is something we take inspiration of. So it's sorry guys, we won't give you our code and our algorithm. So that's the quick answer. We spend a lot of blood and suffering in producing it, but still we are more than happy to share what are the main ideas behind our models and where we took our inspiration and what are actually the state of the art of mathematical modeling in this environment.
Good. I think that there are still a few questions, but I think we covered the most interesting topics. First of all, let me say that in general, there is going to be a recording. We will email you about when the recording is available, and this time we will share also the slides of the presentations, because some of you asked. If you're interested, we're happy to share them. Unfortunately, the time for this webinar is about to end, and yes.
There was a question to answer, Mario, from Francesco. Francesco asked about the Liverpool trade. That wasn't a trade done by Mercurius, as I precise. It was my personal trade. I've done to show the concept about how to use a qualitative approach to betting on uncertainty. That the one indeed, since we are quantitative traders, we don't bet, for example, Champions League, Europa League, because it's difficult to price, or cup games. Also, we have the data. Our bot is not yet betting on those exact type of events.
Yeah, we are extremely prudent.
Good. Thank you, guys. I don't know if is there any other specific question would you like to answer? We have really a couple of minutes, then we should close.
I didn't check.
I don't think so.
Okay, it's good, guys. I think we almost hit the 2 hours of webinar. I think it's enough. I'm happy to see that again there were a lot of questions and also a lot of comments in the chat. You can get in touch with us by writing to Carlo at mercurius.io. We can follow. You can live here. Exactly to Carlo. You can follow us on Twitter at I think is it Mercurius.io, if I'm not mistaken. You can also follow us on Facebook. If you look for Mercurius Betting Intelligence, you'll find it. And I hope. Sorry, Carlo.
Also on Twitter as well.
Yeah, on Twitter, it should @Mercurius.io is our Twitter account. So, guys, thank you very much for this webinar. I hope that everybody enjoyed it. and see you soon. If I can ask you guys that you're following, we'd like to ask you a few questions after the webinar. We are going to send you an email with all the details for the replay and also for getting some feedback. We would like to understand what you think about this experience, and maybe also to get some inspiration for the topic of the next webinars. So thank you very much, and have a nice evening. Bye. Bye.
Ciao. Bye.